Glenn first called me up and asked if I'd come and speak here and told me a little bit about the organization. I was thrilled to have the opportunity to do it, and we discussed a number of topics. And because that I had worked in dealing with financial disasters, financial crises throughout Latin America, and the prevention of them and the solution, he said, "Why don't you talk about that?" And I was thinking, this was, what, 3-4 months ago, and I was hoping that it would maybe be over. And I wasn't sure exactly what I would plan to say on it at that point. It was very unclear how it was developing. And so we talked about several other topics, and one of the areas that I had been able to work in when I was at the Inter-American Development Bank was on the financing of natural disasters. Often natural disasters can't be prevented. They're mainly nature getting back at us. But there are a number of things that can be done to prepare for them financially, to be ready for them, and to address those needs. And so what I'd like to do is spend this afternoon talking about that topic and how markets can be used and how access to markets can be used to protect the most vulnerable. And as he indicated, I would be willing to address some questions that you would have, both on the risk management and the financial, both on the risk management for natural disasters and on dealing with financial crises. I'm thrilled to be in Colorado. It's nice to be back in the West. It's nice to see those blue skies when I wake up. Although it would have been fun to be in Washington for the inauguration, it's sort of nice to be out of the humidity and out of the awful weather that they have there. And it's nice to be able to wake up and not have every conversation be about politics. The other thing that really thrills me about being at Colorado State University is about 18 months ago, they started a program on global, social, and sustainable enterprise. This is a Master of Science in Business Administration, where they bring in 25 students each year for an 18-month program. I believe we'll be extending that to a 2-year program at some point. Half of the students come from overseas, largely from emerging countries, emerging markets. The other half come from the United States. And these are students that want to make a difference in the world and want to use the tools of business and economics and finance to do that. This is what really attracted me to come here. I thought that I'd be able to use my experience in developing markets, in understanding the risks that are associated, and give some insights to these students. And we have wonderful students in that program. And if you ever have a chance to be up at Fort Collins or to see one of their student presentations, I'd invite you to take advantage of them. We have some tremendous students there. Let me begin to talk about natural disasters, and I want to divide this up into what I'm calling natural disasters in the large. These are the ones that affect countries, that affect, that have a major impact on countries and individuals and corporations. Here I have a graph. I'm hoping that I'm not walking in front of it so everyone can see it, of the natural disasters as measured by Swiss Reinsurance Company. There's a very pale blue line that sort of goes on top of the blue line that's showing the total risk. And if we look at this chart over the last 25 years, I believe it is, for about the last 35 years, we've seen a steady increase in these disasters. And it's not that natural disasters are happening more frequently, but it's that the way that we've set up our urban development, where we've built our cities, how we've built our cities, the increasing urbanization has resulted in an increased cost of natural disasters to our economy. And I want to mention that this graph is only measuring those natural disasters or those disasters that were covered by insurance. Most of the disasters in the developing countries, from the Asian tsunami to hurricanes in the Caribbean to earthquakes in Central America, are not covered by insurance. And therefore, this graph probably covers only about half of the disasters that exist. So we can look at these. We have the issue of earthquakes in Turkey. One of the things that we look at when we look at the country of Turkey, it's been devastated by earthquakes for a long period of time. And one of the issues that we had in Turkey was that there was no earthquake insurance. If we look at Turkey and we compare it to California, they have similar fault systems. But in California, we have insurance against earthquakes. In Turkey, they didn't. One of the problems that you have when you don't have insurance markets is you don't have anyone that's enforcing building codes. And much of the disasters that come in Turkey in their housing markets, in the apartment buildings that they're building, are because they have very poor construction codes. And not that the legal codes are insufficient, but the builders don't follow them. And so, and I would say it's a combination. The building codes are probably not sufficient as well as the builders not following them. So they have a minor earthquake, and you have massive devastation. Whereas if you had better building codes, that would take place. When I first became involved in natural disasters at the Inter-American Development Bank, we were looking at a project in the Caribbean. Barbados Light and Power was paying insurance premiums every year, and Barbados is outside of the outside of the hurricane belt. They expect to get a hurricane, a category 4 or 5 hurricane in Barbados, about every 75 years. You compare that to Jamaica, and they have it about every 7 years. But because the insurance markets were not doing a very good job at distinguishing between the risk in Jamaica and the risk in Barbados, they were charging them the same premium. And following some very large losses in the northern part of the Caribbean, many of the insurance companies, including Lloyd's of London and American International Group, pulled back from providing the coverage. And so the remaining coverage became more and more expensive. And it got to the point at Barbados Light and Power where the insurance payments that they were making got up to the level where the board of directors had to approve those expenditures. And the board of directors looked at this and saying, wait a minute, we're paying an insurance premium to cover our plant and our transmission lines that was equal to about 25% of the value of those transmission lines. You know, their plant is probably not going to be affected by an earthquake. And when we talk to the engineers, he says, what you need to do there is tighten the bolts, make sure it's properly maintained. You can reduce significantly the cost of protection of the transmission line by just being careful in doing the maintenance. You make sure that you're building them on the right side of the island, on the leeward side and not the windward side. Just below the sound. Let me speak loud. By making sure that the posts are not planted where water collects, by purchasing the power poles that can withstand the winds. And so we worked with Barbados Light and Power to try to develop a Caribbean-wide risk insurance facility where we would try to simulate what an insurance market would be like. One of the interesting things that we learned from this is the Barbados Light and Power Company was very interested in doing this. It was a privately managed company. They wanted to make sure that they could provide electrical energy to the island as cheaply as possible while making a profit. Many of the other utility companies through the Caribbean were publicly owned. And when we approached them about doing this, they said, well, the insurance premium goes up, we just increase our rates. No problem, we just pass on that cost. And so Barbados Light and Power was unable to develop this with a group of countries from the Caribbean, so they ended up doing it on their own and creating some specific programs on their own that we helped them develop, but we weren't able to develop something for the wider Caribbean. So this was a little bit of a frustrating experience. I decided that I wanted to spend some time looking at more of that. Here we just have a couple of pictures of the devastation that hurricanes can cause. I'm sure that you've seen all of this. Now we also have natural disasters, which I would refer to natural disasters in the small, in that these are the disasters that are affecting the very poor. We have farmers in Peru, which are subject to the risk of the El Nino weather pattern. That about every 10 years, you have an El Nino event, which means they're going to have either too much rain or too little rain, and their crops are destroyed. Their livelihood is destroyed, and because of this risk, they're unable to obtain bank financing, and so that they end up being much poorer than they would normally be. And with these El Nino weather patterns, about every 4 of these cycles, you have a severe one. What I have here, and I apologize that the title is written in Spanish because I was copying this picture in from a Spanish article. You have the yield for copper farmers in the southern part of Peru. And what we see is, if we're looking over the last 20 years, we've had a huge cycle in the production of copper, which is related to El Nino. And if we're looking at this strike point that's going across here, this is sort of the level of yield that they need to have in order to support a loan and in order to have sufficient production that they can continue. And we just have a few years out of those 20 where they're much below that strike point. This is clearly an insurable event, but insurance doesn't exist for the small cotton farmers in Peru. And again, they're locked out of the financial markets, and the level of production is much lower. We have a similar situation in Malawi, which is a very interesting project very interesting country, because this is one where insurance markets have recently been developed, where we have farmers that are producing corn and peanuts, and again, they're very subject to drought. And one of the things that the investigators that were looking at this drought were looking at is, what are the farmers planting? And they had just developed over centuries of time a very drought-resistant crops.
Try the mic again.
Shall we try to resist? No. So they had developed. So they had developed a fairly drought-resistant strain of crops. The only problem was that the yield was extremely low. And by switching to a high-yield grain, a high-yield crop, they were able to increase their production by more than 100%. You're almost doubling production, doubling the income of these farmers, except that every 10 years when they had a drought, there would be a complete loss. So if you take out that loss every 10 years, you've increased the production by 80%. But you need to find a financial mechanism in order to allow them to switch that. And we really have these common elements of natural disasters in their effect on the poor. We can't control the frequency, but what we notice is the cost of this risk falls primarily on the most vulnerable, falls primarily on the most poor, and falls primarily on those countries where the governments do not have the capacity for dealing with these problems. And so we find that the risk do manage this risk. They do like the Malawian farmers, and they develop informal processes. Throughout Asia, they are informal insurance arrangements. In Peru, there are informal insurance arrangements, through family ties, through community ties, but they work very poorly, and they're very expensive. The poor manage financial risks, but they do it in informal methods, which provide them very poor protection and provide very, very poor coverage for them.
There you go.
Are we back? Yes. Is that better? Let me talk about what was done in a few examples. And the first one is the Turkish Catastrophic Insurance Pool. This was a program that was set up between the World Bank and the Swiss Reinsurance Company. And again, we have here a comparison of Turkey and California. It's not entirely to scale. Turkey's area is not quite. It's a little bit more than 150% of the size of California, but they have a very similar fault pattern. They've had the same kind of major earthquakes, and they decided to see what they could do to reduce the risk to the most vulnerable. And so they set up a program which used private insurance markets and a reinsurance facility that was set up inside of Turkey with support from the World Bank, support from Swiss Re, and support from the Turkish government. And they did some extremely important things. First of all, they did a documentation, a risk mapping of what the vulnerabilities were and how it happened. They established the building standards that were needed, and they used the insurance industry to enforce these building standards. Those buildings that were not built up to standard were not able to obtain insurance. For some of the buildings that had been built before the standards were established, they had retrofitting kits that were made available that would reduce the vulnerability and allow them to have access to insurance. They set up the linkages with the international reinsurance markets, which was able to provide this insurance protection at a much lower price than the Turkish insurance industry could, because the Turkish insurance industry had a very concentrated risk. They also set this up so that you could have insurance policies that were available to the most poor. There are some of the policies that were available as little as $8 or $12 a month for very small houses. And at this point, about 20% to 30% of the market has insurance coverage, which is a level that's similar to the percentage of California homes that purchase insurance. And in the most vulnerable areas, where those that are most accessed, where the risk is greatest, they have an even higher percentage. Mexico is also subject to catastrophic risk of earthquakes. And in Mexico, because of the earthquakes are concentrated in the area around Mexico City, their greatest vulnerability is concentrated in that area around Mexico City, the government decided that rather than trying to develop the insurance markets first, they needed to provide some kind of catastrophic protection to the Mexican Treasury. Because when disasters hit, the Mexican Treasury did not have enough money to spend in dealing with the financial costs. The rebuilding of the assets that belong to the Mexican government, the hospitals, the schools, the roads, the bridges, as well as the very high cost of social protection that followed a disaster, providing temporary housing, providing food for the individuals that were involved. This is part of a long-term plan that the government of Mexico has to develop its internal insurance markets, but they felt that they needed to do something immediately. And what they ended up doing was creating the first catastrophic bond that was issued by an emerging market. And what these bonds do is they allow the Mexican government to have immediate access to financing in the event of a catastrophe. So you could think of it that Mexico would be borrowing $300 million. And in the event of a disaster, they wouldn't have to pay it back. This bond would have a higher interest rate than normal bonds because there's the probability of having this default that's based on a natural disaster. But this becomes a very good asset for investment funds to invest in if they do it as part of a very widely diversified portfolio. They get a small increase in the return, which is greater than the increase of risk that they have. And this is a risk that is not correlated with any of the other risks that they have. They set this up with a parametric trigger so that they didn't have to have the insurance company come into Mexico and measure what the losses were and go around each of the neighborhoods and say, well, what was the loss that was set up? They set it up with a trigger saying if the disaster on the Richter scale was 7.5 or 7.8 or 8.4, that there would be a payment that would be associated with what the level of the trigger was. Another way of reducing the cost significantly. The World Bank came along 15 years after I'd started trying to do something with the Caribbean and was able to create a wider facility, doing something similar to what the Mexican government had done and what the Turkish government had done in creating this catastrophic risk insurance facility where you brought in insurance companies, reinsurance companies. In the case of the Caribbean, they brought in some donor capital from the UK and other European countries that were willing to provide the seed capital for this insurance market to start. And they got 15 countries in, and being able to pay premiums that were significantly lower than that. As I mentioned when we started about the Malawi, I think this is one of the very large success programs because, again, they were able to use this catastrophic trigger where they set up these remote automatic weather detecting stations, and depending on the amount of rainfall that they had, they would be able to trigger for the farmers this insurance coverage. I think that they did this in a very clever way in that they sold this high yield seed together with an insurance certificate. So when the farmers was able to purchase this seed and double their production, they didn't have to worry about that 1 year out of 10 when the drought hit and they wouldn't have the production. This was set up very carefully with some agronomists looking at the time of when the wet rain stopped, the amount of rain that they had during the season, etc. I'm sure that none of the farmers completely understand the model, but what they recognize is that the amount of the payment that they will be receiving will compensate them for that reduction in the yield. Now, one of the interesting things is after they had created this, they started looking at other countries in Africa, and they determined that there was a negative correlation between Malawi and some of the countries in the northern part of Africa, that they had never had a time when you had a drought in both places. And so by setting up an insurance program that covered two countries of a similar level of development, you could cut the insurance premium by 50%, because you're reducing the risk by half. Yeah. Ignore that slide that I would go into much more detail with my class. I want to return to Peru because this is a project that I was working on at the time that I left the Inter-American Development Bank, and that we're trying to continue to work on from Colorado State University. We have severe issues that are facing the poor in terms of agriculture. Many of the farms are very small. Like Malawi, they use very poor quality of seed. There isn't an extension service that's provided by the government that helps people determine what kind of seed that they should be using, when they should be planting it, what kind of fertilizer they should be using. And the Peruvian Ministry of Agriculture at one point had some funding that was available for innovative projects. And one of the projects that was performed was what they referred to as productive chains. And what they ended up doing was creating something which would be similar to an agricultural cooperative, or the Grangers that existed in the West in the early period of the United States, where they would hire an agronomist that usually had a connection to a local area that would go in and organize a group of farmers. And these were farmers that had very small plots of land, probably ranging from 4 to about 40 acres. And they would bring them together, and they would create that full productive chain, in that they would, first of all, arrange for them to all produce the same crop. They would plant at the same time. They would plant a very high quality of seed. They would use the appropriate levels of fertilizers, and because they were doing this together, they could purchase them wholesale. The other thing that they did was they created the connection with the market. They found in this experimental program a poultry producer that was producing poultry for export, that had long-term contracts and that needed the yellow corn to feed the chickens. And so they agreed on what the price would be. And this way you a little bit eliminated the middleman who was coming to these Peruvian farmers and purchasing their corn or whatever they were producing and saying, you know, these grains aren't all the same size, our chickens can't eat them. And so we're only going to be offering you 75% of the value of the price. And telling them that the value of the production in Lima, where they were selling it, was a very low price, whereas the true price was much higher, but there was no information. And so you were able to get more of this income to the farmers. Now the problem that still remains is this El Nino risk. Because with this productive chain, they were able to get access to credit. Because it'll be the poultry farmer who has a very high credit rating that is repaying the bank. And then any excess that goes there goes back to the farmers. And like Malawi, when the farmers that were involved in this had their production increase by 100 to 200%, basically tripled their income in some cases, but they're still facing the risk that every 10 years they would have an El Nino event. And if it was a severe El Nino event, they would lose their land to the bank that was lending them and taking that as collateral. And so what we're doing is we made a proposal to the Hernando de Soto group in Peru to try to superimpose these kind of insurance markets on top of these productive chains, so that we would be able to resolve both problems at the same time. So that in addition to the agronomist coming and organizing these groups and sort of doing a self-selection among the farmers, making sure they're producing the right product, making sure that you have a link with the market, and making sure that you have the financing available, that you have an insurance policy that would make a payment that would cover the amount of losses that they had from the El Nino events. And this is something which is impacting these very small, very poor farmers that have very limited land holdings, and is a way to significantly increase their level of income, their level of production, the overall wealth in the agricultural system in Peru. And one of the things that I like about it is that you move this formal risk management into the private markets. Whereas before, if you had the same graph that I was showing you before, if there was not sufficient production, there was a very high probability that the mortgage on the farmland would take over, and the small farmer would lose everything that they had. They had very little incentive to improve their land because there was this very high probability that they might lose it to the banker. So they would choose not to use that at a very much smaller level of production. This is a way that we see it really increasing it. With this, you have the agriculture becoming credible in financial markets. But the idea that I really want to get across this is that there are ways of dealing with the financial needs that come up with natural disasters. And there are ways that you can do that impact the very poor. There are already markets that exist, insurance markets that exist that will cover corporate risks, that will cover the risks that we have in housing in California, of hurricanes in Florida. But very often these markets are very poorly developed in emerging markets. And by moving from this homemade risk management that the individuals do, through family ties, through savings that are held in very illiquid, on a very illiquid basis, by moving these to formal markets, and by able to transfer these risks to large insurance companies, large international reinsurance markets that are able to diversify these risks within their whole portfolio of insurance, you're able to do this at a very low cost basis. And I think that's one of the challenges that we have when we're working with development. We need to find out how we can get that impact of development to the very poor. We've had a lot of development activities that have helped the countries in Latin America, helped the countries in Asia, but a very large percentage of this has been concentrated in the upper middle class and the wealthy in the countries. So what we need to do is have the challenge of saying, how can we create the markets? How can we create the instruments? How can we create the mechanisms that will bring this down to the very poor, what I refer to as risk management in the small. So I appreciate being able to present this to this evening, and at this point I'm willing to answer any questions that you might have.
Paul Polak, a neighbor of all of ours, and you probably know Paul.
Yes.
Okay. He suggests that the poorest of the world, a few billion people, are living on, if I'm not mistaken, $1 to $2 a day, and they're virtually all farmers. Now, if these farmers with whom you're working, let's imagine therefore they're living with 30, maybe max, $60 a month. And you suggested insurance if I've understood you, that you can sell them and they'll pay $8 to $14 a month for the insurance?
This was the insurance for homes in Turkey. That was not for the very poorest.
Okay.
When we're looking, for example, in the Malawi, this was a very small portion of the cost of the seed that they were purchasing. So you may be talking about $1 a month insurance premium, which would allow them to increase their daily earnings from $2 to $4 or to $6.
Okay.
So you have to think of it in that case. And one of the difficulties is creating insurance products that can take that very small premium. We can't send insurance agents around to try to collect that. But if we sell it as part of the seed, if we sell it to the bank that is lending them the money as a way of reducing the risk and having that pass through to the farmers, that if the weather turns against them, that they don't have to pay back the bank loan, that they have some kind of payment that is going to them, that you make up for that very small cost, and you do it in a very cost-effective manner. Paul Polak is amazing in what he does, because he tries to find very inexpensive products that will create additional wealth. The treadle pumps that he has, where people can be out there, sort of with a stepmaster all day, bringing water into their fields, creating ways that you can create irrigation in the off season. Well, these are the kind of things that make a difference. What I think that we're trying to add into this is saying, what do we do about these catastrophic events? That if that river dries up, you can walk on that treadle pump all that you want, but you won't be getting water onto your field, or you won't be getting enough water in your field to support the loan that you may have taken to purchase the seed, to purchase the fertilizer, etc. So we want to find ways that increase the production and at the same time reduce the risk, and do that in a very cost-effective manner. So we need to have these be carefully structured. Is that? Oh.
Thank you. Yes.
Is there?
You travel all over the world, and I seem to have overlooked an event that happened in Micronesia, and I'm wondering, does any of this discussion apply to that, or is it just too rare?
I think the tsunami, you're referring to the tsunami, I think that was such an extreme event that when you look at it historically, there's some archaeological evidence that this had happened, about 800 years prior to that, a similar type event. There's some recent archaeological evidence that indicates that there was a civilization in Peru 3,000 years ago that was absolutely wiped out by a combination of earthquakes and flooding and the El Nino coming together. I think when you have that kind of event, almost becomes uninsurable in private markets. The cost is too high. What you can do is work on having the disaster mitigation systems present, making sure that you have that tsunami warnings that we have around Hawaii. They're not very expensive to put in, but there was nothing in the Indian Ocean that was giving an early warning to these individuals to move uphill. So you could have reduced significantly the loss of life. But I think that's a place where the international community was able to get together and provide some support. The son of some friends of ours, on his own, sort of heard about that, dropped out of school. He was going to school in Southern California, just sort of dropped out of that semester and flew off to Thailand and worked on a little island doing reconstruction for a year. I think there are many other people that did that kind of effort. He said that there were people that were sort of having a layover in Thailand from one of their business trips, and they arranged to be there for 3 or 4 days and came over and helped. There was a lot of international assistance that was needed. I think that this is, the tsunami was at the level that this is really something that is a socialized problem where the international community needed to step up. And I think they did so somewhat effectively. More difficult sometimes to spend the money that's available. Yes?
I understand these solutions, and they're very clever and they're very specific. So what I'd like to understand is, what are the skill sets of the team? Obviously, this is a team effort. Some banker or some insurance agent didn't sit in their office and figure this out. What types of people, what skill sets do you have to have for the team members involved to make one of these successful?
You're right that you have to have a combination of skills. You need to have people that understand the risks, that you understand the disaster risks, can do the mapping. There are something that didn't exist 15 years ago, are some companies that do disaster mapping that can figure out what the probability of hurricanes is in the Caribbean, the probability of earthquakes in Central America and in Mexico, so that people can sell these financial instruments, say, this is something where you have a 1% probability of loss. So that risk mapping ability is critical to it. When we're looking at the other ones, it's a matter of getting the organization in on the ground to educate people. In the agricultural ones, it's having people that have the local knowledge and those local skills to be able to convince people that they should use this higher yield seed, that you're creating the confidence among the people that with this higher yield seed, that if you have that disastrous loss, that you'll have the payment. So it's a lot having people gain the experience. One example that I didn't bring in, but the one that I make my students read is what happens in Cuba. If you look at the Caribbean, Cuba's right in the middle of that same hurricane belt that the rest of the Caribbean is. If you compare the Dominican Republic to Cuba, the deaths that come from hurricanes are 1% in Cuba of what they are in the Dominican Republic, because they've been able to create community organizations. They have plans in place, they practice these places, they have people that are assigned to help move the older people out. They have early warning systems, the same kind of early warning systems that they have in the Dominican Republic and elsewhere, but they have the system set up to communicate those. So a lot of it is organization. On the insurance side, when we're looking at these agricultural insurance, you need to have people that are very creative in figuring out how can we reduce the transaction costs. Insurance tends to be very expensive. When you purchase your automobile insurance, there's a 15% premium that goes to your agent. There's a certain amount of the cost that goes to the marketing expenses, etc. If you reduce the size of that contract and you make this a contract that's going to pay somebody $150 if they have a drought to help them cover that, having an agent there is going to charge more than 15%. It might charge 50%, and it becomes a non-viable product. If you can find a way to reduce that, so it costs $0.25 or it costs $1, then it becomes a viable market. And there are people that have been working in microfinance that are moving these skills to microinsurance markets and finding ways to reduce those costs. But it's a lot of hard work. Yes?
I have a twofold question. One, I am operating under the assumption that most disasters that occur around the world don't have these kinds of imaginative solutions so that the poor suffer greatly, and that's the question. Is my assumption correct on that? And the second question, and the second question is, if that's true, should we be simply relying on private enterprise to see a way into this kind of area, or should we be developing through governmental agencies or through the United Nations the focus on these kinds of issues to get some solutions moving?
I think that, first of all, for the first question, yes, these are largely uninsured events. And these programs that have been set up have usually been done with foreign assistance. The World Bank has been the most involved. With the Caribbean project, we had some involvement from the Inter-American Development Bank. We had some involvement with the Organization of American States. But the World Bank has really been the leader. Several of the reinsurance companies, particularly Swiss Re and Munich Re and Allianz, have also been very involved in this because they're seeing this as a new source of income for them and a new source of risk which they can diversify because it's not correlated with the risk. They can only sell so much hurricane insurance in Florida before they have too much risk on their balance sheets. They can only sell so much earthquake insurance in California or in Tokyo before they have too much insurance. If they can find something that's not correlated with that, which could be this El Nino risk in Peru, and that may have a negative correlation in some cases, they're able to provide this at a lower cost. So you have the private insurers that are moving towards this, but much of the organization requires the role of non-governmental organizations, the international development community, to help this development. Now, the few that have been taken place have been very expensive to develop. They're pilot programs. And they've been going through the process of figuring out how they do this. And what they need to be doing is creating a mass market for these. That means learning best practices, training people, developing the local insurance markets and the connections with the international insurance markets, and really helping people understand what the risk mapping is. That's not something the Malawian farmers can do by themselves or the Malawian insurance industry. And it's something that may not be of a lot of interest to a large Colorado insurance company. For them to go over to Malawi or down to Central America, down to Peru, may be too expensive. But if we can develop that locally and be able to show that this is something that can be done profitably, it can be done at a distance, and then you diversify that risk over a large number of private sector insurers and reinsurers and over the capital markets, then you have a product which is viable. And that's the challenge that's faced in really making this a commercially viable product. And these products that I've talked about have become commercially viable. There's certainly donor support at the beginning, but once that support is in there, these are self-perpetuating.
We had a question in the middle here.
Yes.
I'm going to back you up a little bit. In Malawi
Okay.
and Peru, before you began this chain of productivity, were they already producing food security or enough food for 1 year for their family or not?
Probably not.
Would you repeat the question?
Okay, the question was in the case of Malawi and Peru, before these productive chains were set up, were they creating enough food security for their family? And the answer was, I was saying probably not, because in a typical year, you were producing most of that, but what you found were people who were abandoning their farms. And part of it was problems with land titling, part of it was problems with how the inheritance worked, that these farms kept being subdivided and becoming smaller and smaller. You have issues in some of the indigenous communities in Peru where all of the property is held communally. And because that they were not producing sufficient food to care for their family, they're all moving to Lima. You have in the case of Peru, and I don't know about Malawi, but in Peru, 25% of the agricultural production is lost between the time that it's grown and the time that it reaches a market. If you're able to address that, if you're able to address some of these risks that allow people and encourage people to invest in the productivity of their lands, then you create that food security. I'd say that it probably doesn't exist, and so what you see is people more and more moving to the urban slums. And if you ever drive along the Peruvian coast, it is sad, because you've had these land invasions by people that have gone out and just moved into a small plot of land, and they basically have a bamboo shack that's sitting there. And if you look at these over years, they're around the airport in Lima. They used to have these kind of bamboo shacks, and then the people would buy a few bricks one year and a few bricks the next year, and then they would build a wall. And over 20 years, they now have a community there. But the ones that we're seeing that are developed at this point are people that are living in abject poverty, probably worse off than they are on their farms in the good years, but they've lost their properties. Yes.
I lived in Africa, the African area, a number of years ago, from 68 to 72 in Malawi. It was always amazing to see the fantastic cornfields. I mean, the hills to measure were just loaded with corn. I mean, it was all over. You go to the nation right next door to them, which was Zambia, and there each little family would grow corn. It was be enough to take care of themselves for the winter, but never enough to sell off to anybody in the nation. And they have some extra money for themselves. But Malawi was one country that had some beautiful cornfields.
And they have a combination of those very large cornfields, but they also have some of the ones that are very small. And with the larger ones, if you own 500 acres of corn, you can survive a bad year, because the banks will know that the following year or the following 2 years you'll be able to make enough money to pay them back. The small farmers can't. And so what we're trying to do is have programs that work at both levels. But you're correct, there's tremendous agricultural richness. In Peru, they grow asparagus. The little asparagus stalks grow about 2 centimeters a day, almost an inch a day, because they have so much sunlight. We've replaced the state of Washington as the major producer of the asparagus that we eat. They produce it year-round. They're tremendously rich. Well, there's a tremendously rich agricultural potential, which is not exploited very well. Yes.
Would you say there are similarities between the cooperative groups being formed in Peru with the Granger movement in the United States at the end of the 19th century?
I would say that there was. The difference is that the Grangers were formed by people that were better educated and that were linking in farmers that were really trying to create markets for their grain. It was the same problem. The person that came out to buy their grain was offering them a very low price, and by joining together in the Grange, they were able to have an agent in Chicago that was purchasing the corn or selling the wheat, that were selling what they were producing and getting a much better price. And then from that, they moved to the agricultural extension, and places like Colorado State were set up as an agricultural school. We still have the A up on the hill for the Aggies, to provide support to them. The ones in Peru are much smaller, and they're not self-generated. The farmers don't have the education, the experience to come together and say, let's do this better. And so it's almost a government outreach program through the Ministry of Agriculture to create these productive chains. I would like to see that as these become more common, that you have private agronomists that come in and organize these, and use private banks to do this, and not just the government banks. I think that's when we can see that there's success, that these are really being generated. But at this point, these are pilot programs. They started out with this probably about 4 years ago with this first pilot program. It's become very successful, and they're reproducing them throughout Peru. One of the hesitations that I have is one of the groups that's really promoting these as a Peruvian government development bank that tends to be politically motivated in its development projects and trying to do projects to gain votes rather than to be economically efficient. And I think that's one of the challenges that we have in this program, and moving it more to a public-private partnership where you're bringing the capabilities of the private sector and maybe a little bit of this support for getting these started from the government becomes very important.
Thank you.
Yes, sir.
You indicated that you might be willing to share another area of your expertise, namely in helping Latin American countries deal with their financial disasters. Would you be willing to share some thoughts on how the United States might navigate our way through our current financial situation?
How much time do we have?
Hour and a half.
Okay. Let me give you a few suggestions. And when we're working with the countries in Latin America, again, the work that we did would depend on the country that we're working with. If we're working with Peru, the kind of program that we have would be very different than we would in Ecuador because of the level of development of the financial markets and the sophistication of the individuals. One of the things that we made sure was that there was good transparency, that you had a very strong, capable financial supervisor. In Peru, we actually supported a program. The superintendent of banks was a Wharton graduate. He got his master's degree in Wharton and had run out of money for getting his PhD, but he was extremely bright. And he recognized that with the financial innovations that were taking place in the Peruvian market, they needed to have supervisors that were just as bright, if not brighter, than the banks. So they actually brought a team down from Wharton to set up a training program for these bank supervisors. They hired some of the best and brightest graduates from the local universities, the economics and finance and accounting graduates. They provided them a very strong training program, and the people that got out of this sort of 2-year-long program, sort of probably 6 months of training over that 2 years, were probably the best trained financial economists in all of Peru. They could run circles around the private bankers, and they were able to create a structure where the risks were understood, where the banks understood the risks better, and where they were able to create that. So this having a very strong level of supervision is important. We worked on developing accounting standards. I shouldn't say we developed accounting standards. We're looking at the ones that were developed by the International Accounting Standards Board. We're working on making sure those were being implemented, both in the banking system and in the corporate sector. We worked on corporate governance to make sure that the corporations were not set up to benefit the minority shareholder or the majority shareholders, which was the family that owned the majority of them, but also protecting the minority shareholders. And then we worked to make sure that insolvent banks were closed down, because insolvent banks have a huge incentive to increase risk, because it's if I take the bet and if I win, I make all the money. If I lose, it's the deposit insurer, it's the taxpayer, it's the financial system. And so we worked on doing that. I would say that if we're looking at the U.S. system, we have a considerably more sophisticated system, but we have a lack of supervisory capacity, and we have a lack of supervisory authority to act, and we didn't have the political will to act until the crisis hit. I think that the financial bailout of the markets was probably necessary, but should have been done in a way that made sure that the shareholders who'd lost their money because that they had not provided sufficient supervision were closed out. that if the government has to, if the bank has 10% capital and it lost 20%, it has a hole of 10%. If the government puts in 20%, the shareholders are made whole. And the shareholders were supposed to be the residual risk takers. They should have not closed down the institutions, but provided the capital to eliminate some of the bad loans and then sold those shares to new investors. The problem is when you have the very large ones, the Bank of America, the Citibank, the other very large ones, there's nobody in today's market that can buy those. But I think that you need to set up the structure that prevents them from doing the go-go banking that we saw at the time of the savings and loan crisis, just this excessive risk, that you're finding ways of reducing that risk. And you find a way that if the government is the one that's really providing the capital, that they have that ownership share, that you remove the management, you remove the board, and you have a board that's set up there to protect the interests of the new shareholder, which happens to be the government. And then you find ways to move that back to the private sector as soon as possible. And you bring the private management, the capable management in. One of the other things, because of the sophistication of our markets, we have a lot of the financial derivatives that are being created. Some of those were created for banks to hedge their risk, for customers to hedge their risk. Some of them were created just to create trading profits. In each one of the financial institutions, you had a risk management committee that was looking at the risks and making sure that they were not excessive. And too often, these risk management committees were overruled. I think if you had a stronger supervision that was looking at these, that was bringing them to the attention of the board and saying, we're going to provide some cease and desist orders if this gets out of way, then the banks would have administered these on its own. Let me just tell you a story of derivatives in 2 Latin American countries. In Colombia, I ran into one of my former banking colleagues, somebody that I knew from when I was doing banking in Chile, and he was the manager of Citibank in Colombia. So I went just to meet the general manager and found out that this was a former friend of ours. So we talked about what they were doing, and he talked very openly. He says one of the things that they're trying to do was create swaps. So this was a market that had a great profit potential for them, that they could cover the risk, that they had the sophisticated systems in place, but that the bank supervisor didn't allow them to do it. They kept asking and they kept getting turned down. There's another Colombian bank called Banco de Comercio that started offering swaps. And I found this really interesting. So we set up a meeting with the president of the bank, and he came in there with the chief financial officer, and we asked them about what they were doing with swaps, and they explained to us what they were doing. And we said, how did you get permission to do this? Citibank keeps asking permission, they keep getting turned down. I said, we don't ask. Now, the way that a bank swap works is you take 2 customers of yours, one of which may have a dollar obligation and one that is generating dollars, and you create a swap with them so that each one of their risks is reduced. But the bank in the middle of that is guaranteeing both of the positions. It's what we call counterparty risk. So we asked the president of this bank, how do you deal with the counterparty risk? And he said, we don't have any. At the same time, the finance manager was saying, we think we have that under control. And I saw this look from the bank president, who apparently was convinced that they were bringing these 2 customers of theirs together and that they were making a contract with each other and not realizing that the bank was in the middle. I would have loved to be a fly on the wall. In Argentina, the Bank of Boston and one of the largest private Argentine banks started doing what I would call uncovered interest rate bets. And they were betting on what the term structure looked like, because the term structure in Argentina at the time that they were tied to the US dollar was fairly similar to what it was in the US. And when you moved out the term structure, the market disappeared. But for the first 2 years, 3 years, it had a very similar shape. So they would borrow short in US dollars and lend long in Argentine pesos. And they had been doing this for about 9 months, and every month they made money, and they increased their position. I think they had a bunch of MBA students that were running this and really didn't understand the model and thought that they had discovered an arbitrage opportunity. Well, this came at a time when the U.S. financial markets were a little bit fuzzy. The Federal Reserve ratcheted up interest rates. And about 2 months later, they ratcheted them up again, and the Argentine market reaction to that was catastrophic. Bank of Boston's branch in Argentina, was not a branch, it was a subsidiary that they had there, lost 25% of its capital in a month. The Argentine bank, as far as I'm aware, probably lost about the same percentage of its capital. If you looked at Bank of Boston, the loss was apparent. You look at the Argentine bank, there was no loss there. They played around with their accounting numbers to have a loss appear there and a gain appear someplace else. It was fictitious. I think that one of the stories is that you have to have transparency. You have to have people that know what they're doing. And when you're looking at these sophisticated models, you need to make sure that the people that are at the level of the board of directors and the senior management understand the risks that are being taken. People in Colombia and in Argentina and other countries really understood credit risk and macroeconomic risk. These MBAs that were setting up these financial engineering products didn't understand either. They understand their little black box, and they really didn't understand what was happening inside that black box. Is that a long explanation for a short question?
That's it. Thank you.